What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about the reality of the situation. And this is something that I have been talking about most of 2023. And I'm going to elaborate on this idea, and I've got actual data to show you and back this up with the proper evidence. So hope you guys enjoy this video and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, I would really appreciate it. And links to our Discord and Patreon is going to be down below if you're interested in joining. Of course, getting access to all the buy and sell alerts, options alerts, trade ideas, members only private videos, intrinsic value spreadsheets, everything's going to be included with the 16% annual discount that's also available until the end of this month. So we've got 10 more days left if you're interested in, of course, joining and getting access to that as well. So link's going to be down below. So this video is going to be focusing on interest rates and the potential for cuts, because rate cuts have been this, this big topic of conversation for the better half of the last year, because everyone's been focused on, okay, when is the Federal Reserve going to be done? When are they going to be done? And when are they going to start cutting rates? Okay, that's the real question. So in this video, I want to break down that the Federal Reserve won't cut rates until they're aligned with two things. And I'm going to go over in one word what they really need in order to cut rates, okay? So first things first, this is the SEP, right? Summary of Economic Projections. We already know that they raised their projections for 2024, something that I, was kind of afraid of. I mentioned this in the overall scenarios, right? We talked about what might be neutral and what might be bearish for the Fed. And you'll notice that the federal funds rate now is sitting at 5.1%, right, for 2024. Earlier in June, it was at 4.6%. So it's 50 basis points higher than what they originally expected. And that's fewer cuts, right? So earlier we were expecting from 5.6 to 4.6. That's 100 basis points. Or 4 cuts of 25 basis points. And now they're pricing in from 5.6 to only 5.1. So that's 50 basis points of cuts, only 2 cuts. In other words, they're expecting fewer cuts, similar to what, again, I mentioned in our different scenarios and probabilities and what might end up being bearish. And this obviously ended up being bearish for the market because we're expecting fewer cuts now. Now, markets are aligned. And I applaud the market really because for the first time, we are indeed aligned, not completely, but for rate cuts, we are. So if you come over to market's expectation from the Federal Reserve going into 2024, you'll notice that the probabilities have changed dramatically. And now the market is still pricing in no hikes for this year. So in other words, we are expected to stay where we are for the remainder of 2023. So in other words, between 5.25 and 5.5%. So in other words, no rate hikes in 2023. However, we are now only pricing in for 2 rate cuts, exactly what the Federal Reserve basically gave us and penciled in their SEP. So 1 rate cut here and another one over here. And by end of 2024, we're going to be sitting somewhere between 5.75 and 5%. However, the Federal Reserve obviously has told us that the expected rate is going to be 5.1, which is going to be over here. So what this needs to happen, what needs to really happen is that all of this right here, what I'm putting in a big rectangle, needs to get pushed just 1 more to the right. 1 more to the right, and the market and the Fed will be on the same page. Literally, if this gets pushed 1 more to the right between 5.5, 5.75 here, right? We just shift one row on the right here, then we'll be aligned with the market and the Fed. But in this video, I want to go over a much bigger topic, right? You see, I've been talking about this since beginning of 2023, and that is why would the Federal Reserve cut in the first place, right? What's the reason for the Federal Reserve cutting rates, right? And that's the most important question that I feel like nobody seems to be asking, right? The Federal Reserve needs a reason. They need a reason to cut rates, just like they needed a reason to raise interest rates. They need a reason to cut them, right? And political reason is not a reason. Next year is election year, right? So there's certainly going to be a lot of political pressure on the Federal Reserve to cut rates, to make lives easier for people, right? So in order to cut rates, that's going to lower the borrowing costs on auto, mortgages, credit cards, everything. and that's going to make lives easier. That's going to probably win votes. It's going to be a political year, but they need a reason. Apart from the political year, from a monetary policy standpoint, their job is the dual mandate. From a monetary policy standpoint, they need a reason to cut rates, right? We've been talking about this. They need an incentive. They need something that makes sense. Okay, why are they cutting rates? They're not going to wake up one day and be like, okay, you know what? Let's just cut rates today. No, they need something of a reason to cut rates. And that reason is going to be unemployment and economic growth, right? As I mentioned before, if nothing breaks in 2024 in the economy, right? If nothing breaks on the labor market front, the Federal Reserve can keep rates higher for longer. That's what they'd rather be, right? Unless inflation turns into deflation and we see a significant deflation in the economy, the Federal Reserve would be happy to keep interest rates higher for longer if we are seeing strong economic growth, strong labor market, and inflation is still above the Fed's target, right? At over 2%, 2.5, 2.6%. That's really what they're pricing in next year at 2.5%, right? And the year to follow, 2.2%. So they're not really expecting, core inflation to come down to the Fed's target anytime soon. Long term, in 2026 is when they're expecting inflation to come down to 2%. But until then, they're expecting inflation to be above 2%. So that is not an enough reason to cut rates, right? 2.6% inflation is not a reason to cut rates. They need economic slowdown and they need unemployment also to increase. And this is a good case in point, right? This is exactly the whole idea. If you come over here, take a look at interest rates. What I have over here is three things. I've got the federal funds rate, right, which is the interest rate in red. I've got the unemployment rate, which is in blue. And I've got the GDP, which is the percentage change in green. So I've got all three things: interest rates, unemployment, and GDP. And look how they cut rates. This is red, right? When they cut rates, they cut during recession when unemployment is on the rise and GDP is also going down, right? So we're seeing negative GDP. In other words, change to the downside. Once again, you see, when do they cut rates? Boom, right here, when unemployment is on the rise and GDP is also going down in the negative territory. You come back to the next time they cut rates over here. Unemployment is once again on the way up, as you can see, the blue line, and GDP also going down. It is negative. Of course, not as significant, but the main key driver, in my opinion, unemployment is far bigger key driver than GDP. Why? Because they mentioned that in their dual mandate, they're focused on unemployment and inflation. GDP is not in their mandate. Jerome Powell literally mentioned that word for word yesterday. He said GDP is not our mandate. It's unemployment and inflation. So unemployment is a much bigger driver of interest rate cuts than GDP is. But they both are because they're both linked with each other. Next time you basically see interest rates getting cut over here. So that's the big decline. That's the red line that we're talking about. Unemployment sees a huge increase. This right here is, of course, the great inflation of 1980s, 1970s. Again, we see, double peak inflation here. Inflation basically goes up twice. We get into a double dip recession. Both times, again, recession happens. The Federal Reserve cuts rates. Federal Reserve cuts rates here. Ooh, that's pretty solid. And this right here, of course, unemployment on the rise this entire time. This right here, again, GDP enters into a negative territory. We've got interest rates going down, and of course, unemployment going higher. This unemployment on the rise, interest rates get cut, and GDP also going down on a quarter-over-quarter basis. This right here, interest rates getting cut, unemployment on the rise, and of course, GDP also in the negative territory. That's the green line and the blue line. So you can see unemployment going up, GDP coming down, and interest rates getting cut. Every single time, folks, we're going back as far as 1950s. In the last 72 years, every single time the Federal Reserve has cut rates when unemployment has gone up and GDP has shown signs of weakness and breaking down and coming down. You can see that in 2020 as well. Why did we cut rates? Because unemployment spiked and GDP collapsed, right? To negative territory. And what do we have right now? So if you come to where we are now, interest rates obviously have gone up and that's put pressure on GDP. So it's going down, but it's not negative yet. Right? It's not negative. Every single time in the past, you can see negative over here, slightly negative over here, negative over here, negative over here, not quite negative over here, but of course, unemployment was on the rise quite a bit. Negative over here, negative over here. So several times, the black line is the 0% line, right? Of course, so this right here on the right side is inflation, is interest rates, unemployment. And then on the left side, we've got the GDP, right? So 0%, right? There you can see that 0%. So what we have right now is the higher interest rates putting obviously a lot of pressure on economic growth. So that's been coming down. But at the same time, look at where the labor market is. It's really, really low, right? I mean, it's about as tight as it gets. So I think, in my opinion, and again, I'm not making a prediction here, but in my opinion, the only reason they start cutting rates is two reasons. Either unemployment goes up in 2020, at the end of 2023, early 2024, or inflation drops down to deflation at below 0%, below 1%, below 0%, to a level where it's like really, really low, and that warrants a rate cut. Those are the only two reasons. Again, we are looking for reasons why the Federal Reserve would cut rates, right? Not just because we feel like it's time. They need a reason to do it. And the only two reasons I can come up with are these. Unemployment starts to go up, and I think the Federal Reserve would welcome that very much. They would be more than happy to see unemployment going up on the back of these higher interest rates, or inflation starts to come down pretty dramatically to a level where we are seeing deflation in the economy. If none of that happens, I don't see why the Federal Reserve would cut rates. I mean, there's no reason for them to cut rates, right? Even though they've penciled that in, but they're starting to fade that outcome, right? We went from 4 cuts to 2 cuts. I wouldn't be surprised if they see no cuts in 2024. If the economy continues to be strong, unemployment continues to be low, and inflation continues to be persistent. So I think that's a bit of a reality check. I think the market really needs to understand is the Federal Reserve needs a reason to cut rates, and that reason isn't going to be coming anytime soon, unless, of course, inflation turns into deflation or we see a significant increase in unemployment. Let me know your thoughts down in the comment section below. Hope you guys enjoyed it, found it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.